If you don't know who the sucker is in the room, you're the sucker. Here's how trading works. Trading is a zero-sum game. That means for every dollar you make, someone else lost a dollar. For every dollar you lose, someone else made a dollar. There is no version of this game where everyone wins. There is no market condition where money just appears from nowhere and lands in your account because your analysis was good. Money moves from losing accounts to winning accounts on every single trade, every single day, in every single market. And yet the overwhelming majority of retail traders go through their entire careers without genuinely reckoning with what that means. They learn setups. They learn entries and exits. They learn risk management. But somewhere in all of that education, the most important implication of zero-sum never gets addressed. If you made money on that trade, someone lost it. Who was it? Why did they lose? And what does that tell you about whether you actually have an edge or whether you just got lucky in a market that happened to move your way? Those questions feel uncomfortable because for a lot of traders, the honest answer is they don't know. And not knowing is costing them far more than any bad entry ever will. Understanding this changes the entire way you approach this game. You stop trying to read a chart and start trying to understand people. And people, unlike charts, have predictable incentives. Think about your best trading month. Every dollar of profit from that month came from someone else's loss. An actual person or a group of people who were on the wrong side of the same trade you were on the right side of. They had analysis too. They had a thesis. They had a reason for being positioned the way they were. And they were wrong. And their capital moved into your account. That's zero-sum, not as a concept, as the actual mechanical reality of every trade you've ever taken. Now think about your worst month. Every dollar you lost went somewhere, into someone else's account. Someone who understood the situation better, or was positioned better, or was simply luckier in that specific stretch. The money didn't evaporate. It transferred. It always transfers. And the traders who genuinely internalize that reality start asking a completely different set of questions. If this game is zero-sum and I want to make money consistently, I need to be consistently taking money from someone. Who is that someone? Why are they consistently on the wrong side when my setup appears? What is it about my strategy that creates that edge, and not just occasionally when conditions happen to go my way? That question is uncomfortable because most traders cannot answer it. They can describe the pattern. They can list the entry criteria. They cannot explain whose money they're taking and why those people keep ending up on the wrong side when their setup appears. And that gap between recognizing a setup and understanding why it works is the difference between a trader with a real edge and a trader who is one difficult market regime away from giving everything back. Because in a zero-sum game, recognizing a pattern tells you almost nothing about whether you actually have an edge in the trade you're entering. Two charts can look identical. The same pattern, the same structure, all the visual criteria satisfied in exactly the same way. And one of those trades will have a genuine edge behind it, because the participant behavior that drives that setup is actually present. The other will be a shape on a screen with nothing real underneath it. In that second trade, you're not exploiting an edge. You're hoping the pattern cooperates. And in a zero-sum game, hope is not a strategy. Hope is just a slow transfer of your capital to whoever actually understands the situation better. A trader who only recognizes the pattern cannot tell those two trades apart. A trader who understands why the setup works can. That distinction is where real, durable performance lives. Recognizing your setup is the beginning of the process, not the end of it. This is the part that most trading education gets completely backwards. It treats pattern recognition as the core skill. Find the pattern, follow the rules, manage the trade. The pattern is the product being sold, so the pattern gets all the attention. But pattern recognition has a ceiling, and that ceiling reveals itself most clearly in the difficult stretches, the choppy markets, the regime changes, the periods where the easy money dries up, and the only traders left standing are the ones whose edge was real to begin with. Here's why zero-sum makes strategy durability so much harder than most people expect. In a zero-sum game, edges get competed away. When a specific pattern reliably produces profits, Other participants eventually start positioning around it, trading it themselves, or positioning against the traders who use it. The pattern starts failing in ways it didn't before. The edge erodes, and traders who understood their edge only at the pattern level have no ability to tell whether the edge is gone or just going through a rough patch. But edges don't disappear entirely. The surface-level expression of an edge changes while the underlying participant behavior that created it often remains. The traders who survive that transition are the ones who understood the mechanics well enough to recognize when a setup needs to evolve versus when the core logic is still intact. They can adapt specifically and intelligently. They're not starting from scratch with a new setup. They're refining an understanding they've been building for months or years. That compounding of understanding over time is what separates traders who keep getting better from traders who stay at the same level indefinitely, regardless of how much screen time they accumulate. Screen time alone doesn't build edge. Asking the right questions during that screen time does. Let's talk about conviction, because this is where zero-sum thinking pays off most immediately in real trading situations. Conviction gets talked about constantly. Hold your trades. Trust the process. Don't let emotions drive your decisions. All true, but conviction isn't a mindset you adopt. It's not something you develop by journaling after every session or repeating affirmations before the open. Conviction comes from one place: understanding. When you know why your setup works, when you can explain the mechanics of why money should flow in your direction in this specific situation, you don't need to manufacture confidence. The logical basis for the trade provides it. When you don't have that understanding, when the entry is based on a pattern you've been trained to recognize without ever deeply understanding what makes it work, conviction has no foundation. It's just a feeling. And feelings in a live trading environment with real money on the line are deeply unreliable. Every retail trader knows this from experience. You enter with confidence, the trade moves against you by 2%, and suddenly that confidence is gone. That's not a character flaw. That's what happens when confidence is built on a visual pattern instead of a logical understanding of what's actually happening on both sides of the trade. Let's make zero-sum concrete with a real example, because the concept is most useful when you can trace it through an actual trade. Think about a breakout setup. Price has been in a range, then it breaks out to the upside, and you enter long. In zero-sum terms, the money you make on that trade has to come from somewhere. Where does it come from? Who lost it? During the consolidation, some traders looked at the same chart and made a different call. They read the range as a topping pattern, distribution before a move lower, and position short. Their analysis was wrong, but it was logical given what they could see. When the breakout happens, those short positions are suddenly losing. The further price moves in the direction of the breakout, the more pressure those traders are under. Eventually, they get stopped out, forced to exit at a loss. When they close short positions, they buy back. That buying adds fuel to the move. Their losses are the direct mechanical cause of part of the momentum working in your favor. That's zero-sum in action. Your profit has a direct source. It's not abstract market movement rewarding your good analysis. It's a specific group of participants being wrong, getting pressured, and being forced to close, and that forced closing pushing price further in your direction. When you see a breakout setup, you're not just recognizing a pattern. You're identifying a situation where a group of participants is positioned wrong and about to be forced out. That understanding is what makes the trade real rather than just a shape you've been trained to act on. And critically, when price pulls back after your entry, you're not just staring at a number going the wrong direction and hoping it reverses. You're asking a real question. Is the participant pressure that drove this move still present? Is new demand stepping in? That question only exists if you understood the zero-sum mechanics before you click the button. Now let's talk about holding trades, because zero-sum thinking changes the way you manage a position in ways that have an enormous practical impact on results. Most retail traders exit their winning trades far too early. The trade moves in their favor. It ticks back against them slightly, and they take what they have rather than let it run to the actual target. The result is a pattern of small wins and larger losses that makes profitability almost impossible regardless of how accurately they're reading direction. The analysis is right. The direction is right, but they're not capturing enough of the move for the math to work. This happens because they have no logical framework for where the move should go or why. The entry was based on a pattern. The target was based on a rule. And rules without logic behind them have no weight when the trade is putting you under real pressure. There's nothing to come back to. Nothing that says this move has a specific reason to go further, and here's the mechanics behind it. Zero-sum gives you that framework. When you understand that the move in your direction is being partially fueled by participants on the wrong side being forced to close, you have a logical basis for what resolution actually looks like. The move isn't finished until that pressure has fully played out. That's not a feeling. That's a mechanical understanding of what drives the price action you entered to exploit. And holding a trade based on that kind of understanding, through the normal noise, through the tests, through the moments that would shake a pattern trader out early, is what allows winning trades to reach their full potential instead of a fraction of it. The difference between staying in a winning trade long enough for it to reach its target versus exiting at a third of the move because you got nervous, compounded across a full year of trading, is enormous. It's often the difference between a strategy that works on paper and a strategy that actually works in your account. Here's a dimension of zero-sum that almost never gets discussed, and understanding it gives you a genuine strategic advantage in how you structure your entire approach. Zero-sum doesn't play out equally across all time frames and all participant types. In some arenas, the participants on the other side of your trades have such significant structural advantages that the zero-sum exchange is heavily stacked against you before the trade even begins. High-frequency algorithms at very short time frames have infrastructure advantages that no amount of skill or analysis can overcome. That's a zero-sum fight you are structurally built to lose. The intelligent response is simply not to fight it. But in other arenas, the zero-sum exchange tilts genuinely in your favor. Large institutional funds managing billions of dollars carry constraints that a retail trader with no one to answer to is completely free from. They have to keep capital deployed. They have to execute trades so large they move the market against themselves. They have compliance requirements that prevent them from acting with the concentration and timing that a nimble retail participant can. Their size, which looks like an advantage, creates predictable behavior that a patient, well-positioned retail trader can repeatedly exploit. Understanding zero-sum at this level, as a map of where the tilted playing fields actually are, lets you deliberately choose to compete in the arenas where your situation is most favorable. Retail traders, as a group, tend to interlate. When price has already moved significantly in one direction, the fear of missing out pulls retail capital in at the exact moment the move is most extended and the risk-reward is worst. This isn't random behavior. It's a structurally consistent tendency. And that consistency means the zero-sum exchange at those moments is reliably tilted against the late entrant and in favor of whoever is on the other side, distributing into that enthusiasm. Large, patient participants accumulate during the periods that look boring to everyone else. The long, quiet consolidations that retail traders dismiss as nothing happening. Those quiet periods are frequently when the most important zero-sum transfer is being arranged. When the move eventually happens, the participants who were accumulating during the quiet period are already positioned. The retail traders waiting for it to look like something are now chasing it. Zero-sum playing out in slow motion, completely visible to anyone who understands what they're watching. The trader who understands it is positioned before the move. The trader who only recognizes patterns is chasing it after the fact, wondering why they always seem to be a step behind. That's not bad luck. That's the zero-sum exchange finding its natural outcome. Here's something concrete to do with all of this, because without a process, the framework stays philosophical and nothing in your actual trading changes. Take your most used setup, the one with the most trades behind it. Pull up your last 20 winning trades. Instead of reviewing them by asking whether you followed your rules, ask the zero-sum question. For each trade that worked, where did the money come from? Who was on the wrong side? What situation were those participants in that made them take the other side? And what forced them to close at a loss in a way that drove price in your direction? You don't have to get the answer perfectly right on the first attempt. The exercise itself, genuinely asking the zero-sum question about your own trades instead of just evaluating your execution, starts building the mental model that changes how you see every future chart. Then do the same for the losing trades. For each one that didn't work, was the zero-sum dynamic you were relying on actually present in entry? Or did you take it because the shape looked right, even though the underlying participant situation wasn't really there? Most traders who do this honestly find a real pattern in their losses. Many of them weren't random bad luck. They were situations where the setup appeared, but the zero-sum mechanics underneath it weren't. And identifying that distinction, separating the trades with a real edge from the trades that just looked like they did, is where actual, durable improvement lives. Not in finding better setups, not in tightening entry criteria, in understanding, at a deeper level, why the edge exists in the first place. Here's the long game on all of this, and it's worth saying directly because it ties everything together. The traders who are still in this game 5 years from now and genuinely better at it aren't the ones who found the best setup. They're not the ones with the most sophisticated indicators or the most expensive data. They're the ones who developed a deep enough understanding of the zero-sum dynamics behind their strategy that they could hold onto it through the inevitable adversity, through the losing streaks, through the regime changes, through the periods where everything stopped working and a shallower understanding would have sent them searching for something new. A retail trader with genuine patience, genuine understanding of why their strategy works, and genuine awareness of which participant behavior they're exploiting is not at a disadvantage in this game. In the specific situations they've chosen to compete in, the arenas where their structural advantages outweigh their structural disadvantages, they are genuinely, meaningfully competitive. The path to being on the right side of that zero-sum exchange is not finding a better setup. It's understanding the one you have well enough that when you enter a trade, you're not hoping the pattern cooperates. You're exploiting a specific, understood, repeatable edge in a market that is constantly redistributing capital from the people who don't understand what's happening to the people who do. So let's come back to where we started, because it should land with completely different weight now. If you don't know who the sucker is in the room, you're the sucker. In a zero-sum game, you're always either the one taking money or the one providing it. There is no neutral position. Every trade you enter, you are either the more informed participant or the less informed one. Either your understanding of the situation is deeper than the person on the other side, or it isn't. And the market, over time, across hundreds of trades, has a perfect record of sorting those two groups into the ones whose accounts grow and the ones whose accounts don't. Recognizing a setup is not enough. It has never been enough. It gets you in the right area. But recognizing a setup in a zero-sum game, without understanding why that setup works, is showing up to the exchange with incomplete information. The person on the other side has their own analysis, their own logic, their own reasons for being where they are. And if your reasons are shallower than theirs, the zero-sum outcome is predetermined. The traders who change that outcome are the ones who go past the pattern. Who asks the zero-sum question on every setup they trade? Whose capital am I taking? And why are they on the wrong side? Who build a genuine mechanical understanding of what drives their edge rather than a visual checklist of what it looks like. Who develop the kind of conviction that holds through a drawdown, holds through a trade testing them, holds through the periods of doubt that end every trader who is only ever working with a pattern and a hope. That conviction doesn't come from screen time. It doesn't come from a better indicator or a more refined entry trigger. It comes from understanding, from genuinely knowing, at a mechanical level, why the zero-sum exchange tilts in your favor when your setup appears, and having enough of a grasp on that understanding that no amount of short-term adversity can shake you off a thesis that's still intact. Go back to your best setup. Ask the zero-sum question. Where does the money come from when this works? Who is on the wrong side? And what forces them out? Build the answer. Refine it every time you sit down to review your trades. Trade with that understanding behind you rather than just a shape on the chart. That's the foundation of a trading career that actually compounds. That's the difference between a trader with a real edge and a trader with a collection of patterns. And in a zero-sum game, that difference is everything.